India's housing story isn't driven by luxury apartments or metro skylines. It is powered by self employed families, small shop owners, drivers, electricians, people who earn steadily but don't have formal salary slips. Lending to this segment is not easy. One wrong decision and asset quality can collapse. Yet, there is a housing finance company that has quietly built a high profitable model here, delivering strong returns, stable asset quality, and consistent growth. But in the last quarter, something caught the market's attention, a sharp drop in the promoter holding. Is this a warning sign or just an optical illusion? Hello everyone, I am Sebi George and welcome back to Decoding Equity. Let us decode the numbers and find out. Today, we are discussing Aptus Value Housing Finance Limited, a housing finance company known for its strong asset quality and disciplined lending model. Sales have increased from 286 crores in December 2022 quarter to 544 crores in September 25 quarter. What really stands out here is the consistency. Over the last 12 quarters, sales have increased every single quarter without even one quarter of decline. This kind of uninterrupted growth is very rare, especially in housing finance companies where the seasonality and the credit cycles usually impact disturbance. It clearly reflects disciplined lending, steady demand, and strong execution on the ground. Profit after tax has also moved in the same direction. PAT has increased from rupees 123 crore in December 2022 to 227 crore in September 2025. More importantly, profits have grown consistently every quarter without any sharp volatility. This shows that the growth is not coming at the cost of margins or asset quality. Such steady profit expansion reflects strong cost control, stable credit performance, and a well executed lending model. Asset quality remains stable with the gross NPA slightly above 1% and net NPA at manageable levels. Credit costs continue to remain under control, supporting profitability. This video is only for educational and analytical purpose and should not be considered as an investment advice or a recommendation to buy or sell any stock. Please consult your financial advisor before making any investment decision. I am not a Sebi registered analyst. After looking at the profitability and asset quality, let us now see how promoters are positioned in this company. Promoter holding remained stable above 60% for several years. As I mentioned in the opening remark, over the last few quarters, there has been a sharp reduction, bringing promoters' stake down about to 24%. Importantly, this decline coincides with a sharp rise in institutional ownership, indicating a structured promoter and private equity exit rather than any deterioration in business fundamentals. Over the last 12 quarters, institutional holding in the company has risen sharply and consistently. FII ownership has increased from about 14% to over 35%, while BII holding has jumped from just 2.6% to nearly 26%. There has been no phase of institutional exit, only steady accumulation. This clearly shows strong long term confidence from both global and domestic institutions. Aptus Value Housing Finance India Limited has consistently delivered strong returns ratios, with the ROE at around 18 to 19% and ROCE close to 15%. Importantly, these returns have remained healthy even as the company scaled its loan book. This shows that growth is not driven by excessive leverage or dilution, but by disciplined lending and strong operating efficiency. Sustained ROE and ROCE at these levels reinforce the quality and long-term sustainability of Aptus business model. In fact, these ratios are best among the peers. Aptus business is geographically concentrated, with nearly three-fourths of its loan book coming from South India. Tamil Nadu alone contributes close to 35% of the total loans, followed by Andhra Pradesh, Telangana, and Karnataka. This regional focus has helped the company build deep local knowledge, strong collection efficiency, and stable asset quality. Geographic mix is a strength because of familiar borrowing profiles, lower operational surprises, and better cost control and faster recovery cycles. Over the last 5 years, Aptus loan book has grown steadily from around 4,600 crore to over 9,000 crores. Borrowing have also increased, but at a much lower pace. This tells us that the growth is not driven by excessive leverage, but supported by internal accruals and disciplined capital management. which is a key reason for its stable margin and asset quality. Importantly, the loan to borrowing ratio has steadily improved from around 1.3 times in FY21 to over 1.4 times in FY25, indicating that the Aptus is generating more loan for every rupee of borrowing, reflecting disciplined leverage and improving balance sheet efficiency. Aptus is currently trading at around 17 times earning, which is lower than its earlier premium valuation. This valuation compression has happened despite the company continuing to deliver stable loan growth, controlled NPAs, and healthy return ratios. As a result, the current valuation appears more reasonable and better aligned with the underlying business fundamentals. Let us look at the future prospects for Aptus Value Housing Finance India Limited. This company is well positioned to benefit from India's long-term affordable housing demand, particularly in the self-employed segment where formal credit penetration remains low. Management has indicated optimism about sustaining around 25% loan book growth over the next few years, supported by strong underwriting, a healthy capital base, expansion into states such as Maharashtra and Odisha, and a higher minimum ticket size of around 7 lakhs, which can improve yield and operating efficiency. At the same time, execution discipline, competition, funding cost, and asset quality trends will remain key factors to monitor. Aptus Value Housing Finance India Limited stands out as a disciplined and a well run housing finance company that has consistently balanced growth with asset quality. What gives confidence is not just growth, but the predictability of execution, conservative risk management, and the ability to compound capital without stretching the balance sheet. For long term investors who value consistency over excitement, Aptus represents a business model that can quietly create wealth over time, provided its discipline remains intact. You are watching Decoding Equity, where we break down business with clarity and numbers. Views expressed are based on publicly available information and may change with the future developments. This is CSAB Charge signing off. See you in the next fundamental analysis. Thank you.